Welcome. I'd like to introduce you to our new Amazon Cashflow spreadsheet. This Cashflow spreadsheet shows you the profits and cash flows for your Amazon business over a 4-year period, enabling you to project into the future where your business will be in 1, 2, 3, and 4 years' time. This is a very powerful tool because it will show you the effect of your current business decisions on the future of your business. It is important to remember that your profits and cash flows are not the same because you have to reinvest your profits back into your business. This spreadsheet will be able to show you when you can start drawing a salary for yourself and how much capital you're going to have to reinvest in your business. In this video, I'm going to show you how to use the spreadsheet and how to look for the weak points in your business. This spreadsheet is a roadmap for you, showing you how to reach your destination or your goals. So first, let's look at some pretty simple models for determining the profit of your business and a process that many Amazon sellers go through. So many of you have heard that 10 by 10 by 1 strategy from Scott Volker of the Amazing Seller podcast. It's a pretty good way of understanding the Amazon private label business model. It's pretty simple. Sell 10 units per day, which is a relatively small number that can be accomplished in most markets and niches. I mean, Amazon is pretty big. You make $10 profit on each unit sold, which over a year equals $36,500 profit. Then just add more products. 5 products equals $182,000. 10 products equals $365,000 a year profit. So you think, well, wow, this is worth going for. $365,000 per year in profit just from 10 products. That's pretty amazing. So basically you have to get 10 products a day, selling 10 a day. So you start to do some more numbers because that model's pretty simple. So whether you do it in the back of an envelope or scratch it down somewhere else, but basically you break it down some more. You go 10 units a day times 10 products equals 36,500 units per year. Then you do some research and you find you can probably sell your product for an average of $20. There's going to be some products that you'll find that greater than $20 and some that are less. And it's going to cost you an average of $6 to get the product made and ship it into Amazon. Then you've got Amazon FBA fees, so we're just saying about $4 for that, and Amazon Amazon fees commission at about 15%. And you go through that process and go, well, their profits $255,000. I mean, I've got to do some advertising and other costs, but it still means $200,000 profit a year. You could quit your job and buy a new house and travel the world. And that's a process that most people go through, but it doesn't take into account when you can actually take that $200,000 out. So now is a good point to ask yourself, well, what are the goals in your Amazon business? I mean, everyone has different goals. So it could be extra money to help pay off the mortgage, or quit your job and do Amazon full time, build up your business and keep all the profits in there and sell it in 3 years' time for a capital gain. It could be earn $100,000 a year, earn $300,000 per year, earn $1 million per year. And by the way, all these goals are achievable and at a pace that almost no other business model can achieve with such a low capital investment. So these are your goals, and you've been through the process of saying, okay, we can sell 10 products a day, we can get to 200,000. We go to 20 products a day and we get to 400,000. But what if the decisions you make now make it mathematically impossible for you to reach your goals? So what do I mean about decisions? Well, the price of your products, how fast you grow, how many products you launch, how much stock you order, how much you take as drawings. I mean, you'd still be profitable. So why do I say it's mathematically impossible? Because it's not about whether your products are good or the number of reviews you have or your fail-safe launch strategy or your email list. It's simply because of cash flow, and the simple mathematics of it don't lie. And this what the spreadsheet does is it looks at the cash flow. And it means that your business could be powering towards your goal and then just stop. And your business will stop because of cash flow. It's the number one reason why any business goes out of business, but in particularly in Amazon business, we see it all the time. People just don't have the cash flow to be able to restock their products. And it's because they've made the wrong decisions early on, and they haven't been able to generate enough profits to be able to fund their growth. So let's look what happens when you run out of inventory. Well, firstly, you run out of inventory, your product goes inactive. It doesn't show up in the search results. Then you start losing ranking. Now, you might be out of stock for a week and get it back in stock. Okay, you'd probably be back in that stock in that same position. But if you ran out of stock 3 or 4 times, or you were out of stock for a month or 2 months, that greater period of you're out of stock means a greater loss of rankings. Other competitors will take your spot automatically, so you've got to knock them out when you come back. So then you need to relaunch your product, which, it might be giveaways, it might be extra advertising costs, it might be discounting. So you've got these additional costs that are going to eat away on your profit in terms of relaunching that product. And when your product is not selling because you haven't got any there, your sales decrease and your profits decrease. And you end up with less cash flow to launch new products and grow. Basically, if you run out of inventory, your business stops. So let's look at the reasons why businesses run out of inventory. There's some external factors. Supplier delays, that the manufacturers are too busy, there's holidays, there's natural disasters, there's production problems. All of you who have been in Amazon business for a while would have come across probably all of those. And then you end up with freight delays, planes, trains, ships, trucks, lost in transit, damaged product. We end up with customs delays, customs inspections, incorrect documentation, which means our stock's held up in customs. We could get an unexpected increase in sales. We're expecting to sell 10 a day, and all of a sudden we sell 100 a day for 3 weeks, and it clears out our inventory. And it could just be poor inventory planning, just not understanding when you're going to need to order stock. But those are risks that you can manage by having adequate minimum inventory levels, which basically means you're going to have money in place or money for stock so that you don't fall below those minimum levels that you need. So you've got some buffer there. But the main reason in Amazon businesses, and you can look across your markets and your competitors and you'll see them disappear, but the main reason that people fall out is they don't have any money to pay for inventory, cash flow. So in this cash flow model that we've dealt in the spreadsheet, we've got an important thing here, which is a dashboard. And if your business shows negative cash, then your business will stop. And all of these figures in future years will be irrelevant. Because if it's negative cash, you can't buy inventory. Your product's out of stock, you've got no sales, you've got loss of cash flow from that, you've got the additional cost to relaunch, you've got a loss of rankings and sales, and your business goes downhill. And it could be just one product that you're missing out on, or if you've got 2 products and one goes out of stock, that's a 50% fall in your sales. Basically, your business goes downhill and you have to rebuild. Now, most of you have found the problem where if your product goes off the first page, it's a lot of work to get it back. So you may get it to the first page in the initial instance quite quickly, and it might be quite sticky. But if you have a go out of stock or something happens and your product falls off the first page, you've got some real work ahead of you to get that back onto the first page and getting organic sales again. Of course, you can just advertise, but we'll show you the effect of that in terms of the effect on your cash flow of just relying on advertising. So now I'm going to give you a quick overview of how the model works, and then we'll go in detail into the individual assumptions and then look at the effect of different things, different changes we can make to those assumptions on your overall profitability and on your cash flow. So in the first instance, we can adjust the daily sales price, the average price of your product. So we can increase it to, say, $21 from $20, and it will change the numbers along here, change the gross profit rate, etc. We can also change the number of products we're going to have. Now, we've got a simple daily sales per product. So we can change that. So we can say, okay, we're going to launch 6 products a year. We could change the average cost of our per unit in terms of freight cost, product cost, FBA cost. We can change the timing of our products. We can change the assumptions in relation to our advertising. We've got a variable, some expenses. We've got an expenses section where we can estimate what our expenses and tax rate and the initial capital that you're prepared to invest in the business. And then we've got an annual P&L and balance sheet, a profit and loss by quarter, a cash flow forecast by quarter, balance sheets along the way. And the balance sheet means that our cash flow model and our profit model works. And we've also got weighted product costs. So we can say, okay, if we've got multiple products, what's the weighted average of those costs? So in terms of the dashboard here, and this is probably what you're going to be looking at in the first instance because it's got all the vital information there. We've got sales, so it just gives a quick overview of sales. The gross profit rate. Now this is going to be an important number, and it'll be tweaking that gross profit rate to see where your effect on your minimum cash in the year. Now, we can see that the minimum in the year is different to the maximum at the end of the year, because what we've got here is this is the amount that you're basically going to need in late June, maybe into the third quarter, to fill up your stock for the fourth quarter. And then we've got an option here in enabling us to actually make an assumption about how much we're going to draw out of the business each year. So in this first instance, we've got nothing there. But later on, we could say, okay, we're going to take $50,000 out there, and it will show you the effect on your cash flow. And then we've got a simple graph here. And what we're looking at is, well, does it go below zero? So the first assumption we've got in here is the daily sales price. We have that as $20. And if you've got multiple products, you can kind of go in here and get the weighted average cost for those products. Now, of course, you can also get that number if you're already selling on Amazon from your business reports in Seller Central. So it'll be under business reports and the daily sales. You could probably convert it to monthly to get an average, and you should be able to see the average sale price you've got there. We can make a simple assumption about daily sales per product. 10's good enough for the purposes of this. You could increase it to more. And it's really, then we've got an assumption about the number of products we're going to launch each year. So this is just a simple way of kind of guessing what this annual units are. Now, if you're, say, already selling 3,000 units a year, you could put that in here and it will just change the numbers round and it'll make things a bit easier. We've also made an assumption as to seasonality, so that we're saying, okay, basically fourth quarter is double every other quarter, but you can change those around to what you want as long as it equals 100%. And then the other thing we've done here is put in just a growth. So when we've got growing from, say, 7,000 to 21,000, we're just assuming that it's increasing over the period. It's not going automatically to 21,000 units. So that way we've got this nice curve that is more reflective of reality. So then we've got our cost of products. So this will be the cost of the product from the manufacturer, including all the, if you've got packaging costs, etc., this will be the average cost. However, if you wanted to look at it in terms of, okay, I've got one product selling at $15.99 and that's costing $3 and another one costing $5, but it's selling more, you could put these in here and it'll give you the average product cost in that. So this in the product weighted price costs. Then we've got the freight cost. Now, let's say that's sea freight. So that's the cost of getting it from the manufacturer to Amazon's warehouse. Now, we might assume that's a sea freight cost at $1 a unit, but let's say we were sending it by air and it was $2.50. Then the thing we have to take into account is that the number of days moving to Amazon will actually need to change as well. So that'll change to $7, say 7 days or 12 days, or depending on which one you actually do, what price you're paying for your air freight. And then we've got FBA cost. I mean, you should know that. You can look up Google FBA calculator and it'll tell you the price for that. Amazon commission, 15%. I'm just going to assume that everyone's in that 15% margin basis. Then we've got these things, so we can say, okay, we need a product deposit first day. Then it's going to take 14 days for them to make an order. We're going to freight it to Amazon by sea in this case, so it's going to take basically 2 months. And Amazon, in terms of once Amazon get it, it's going to take 7 days for them to kind of spread it around. Now that could be 3 days. So what I mean by spread it around is you're going to send it to the distribution warehouse, then they're going to send it to all their other logistics warehouses all around the United States. And then we've got the average order period. So if you're ordering every 3 months, then that will be 45 days. So it's 90 days divided by 2. If you're ordering every 6 months, of course, that's going to be 90, and it will change your numbers round because you're holding stock for a longer period. Of course, if you're ordering every month and just having this continual flow in, it could be down to 15 days, which is going to make a difference to the amount of stock you have to hold. Then we've got some advertising expenses here. Now, what we've kind of worked it on the basis of saying, okay, we're going to generate, in this case, 10% of our sales from Amazon PPC. The 90% are going to be organic sales. We could change that to 15%, change it around along the way, but let's just have it for 10%. And then we've got your conversion rate from PPC. So we're saying, okay, it's going to be, in this case, 7%. It's worthwhile looking in when you're doing this to see whether your conversion rate from PPC, which is basically orders divided by clicks, is the same as your conversion rate from organic sales. Often you'll find that the PPC conversion rate is significantly lower, which will make it a major difference to how much, what your advertising costs are going to be. And then we've got a bid cost. You can change that to whatever your average bid cost is. We've also got in here some variable expenses. Now, I've got in here these here at 2%, but these are for expenses that will increase in the level of sales. So things like Forex fees or sales tax, GST, VAT. It could be other expenses that you've got in place that kind of move at the same level as expenses, as sales. Then we've got these fixed expenses. Now, these are things like wages, accountancy fees, it might be travel, it might be some subscriptions you've got, it might be conferences, training seminars that you do, and you can change those to whatever you like. It could be employees or VAs along the way. And we've also included a tax rate of, and in this case, it's the Australian company tax rate of 27.5%. Which will enable, the assumption there is that you're going to have to pay tax on it. We'll pay tax the following year and 1/4 of the previous year's profits. So each quarter you pay 1/4 of the previous year's tax payable, that's rather. And it assumes that the owner's salary, in this case, will be deductible. Then we've got another amount here, which is the initial capital to invest. So you might have, we can change these two numbers around, but the easiest way is, okay, I've got $20,000 to invest or $10,000 to invest, and that will basically be your opening cash value on your cash flow forecast. Now, you can also put in some inventory, say if you've got $20,000, say you're already selling, already things in place, you could put $20,000 there as the your inventory on hand ready to sell, and it will show up there and it will change your cash flow requirements because you won't need to buy as much product. So it's probably worthwhile having a look at this cash flow spreadsheet in terms of how this works. So we've got opening cash, we've got our sales, gross sales revenue. So this is, in some ways, we've taken up, you're going to get net, but we've included as gross. So this is the sales you're making, less the Amazon commission, less at 15%, less your FBA fees, less your advertising, less your variable expenses, less 1/4 of the annual expenses you put down, and the purchases. Now, this is the difference, is that it takes into account the purchases you've got. And in the purchases, we're basically saying, what is your closing inventory required? And then we basically say, well, so we calculate what the closing inventory is based on the number of inventory days you've got, and then say, okay, the difference is what we have to purchase. So that feeds into the cash flow spreadsheet, and again, later that feeds into the balance sheet, and we can see here that is all equal to 0. That means that our profit and loss, our cash flow, our inventory, and our balance sheet are all behaving themselves, and we're getting the right numbers. So let's look at what happens with your business in terms of the profitability and how it's actually working. So let's say, in the first instance, well, let's look at this one. We've got a average $20 sale price, and the minimum cash, we've got 2 products. We'll change that to 5. So we're basically almost tripling each year. So we're tripling the size of the business each year. So we're going from 2 products to 5 products, from 5 products to 15, 15 to 45. Pretty rapid growth. I mean, sales from 146,000 to 3.2 million. This is achievable. People do this. And we can see here an interesting thing is the minimum cash requirement is that we need $6,000 in the first year, and the minimum cash goes down to $22,000. In the third year, it goes down to $37,000, and in the fourth year, we've got really $137,000. So if we wanted to take out, let's say we quit our job and we want to say, oh, okay, let's take out a minimum of $50,000 each year, we're going negative pretty quickly, aren't we? So at any of these points, we're going negative. So it's important to try and look at what you're taking out. Remember, if this goes negative, your business stops, completely stops. The other thing to remember is that this is fairly thin. When you've got a business, if you've only got 6,000, 22,000, 37,000 there as the minimum cash balance, that really assumes that you can't have any mistakes. So let's see what happens if we drop the price by $1. We're finding things hard, and we want to boost things up to reach our goals. So we're going to drop it by $1. Okay, so we've got basically there's almost no money available for the first 3 years. None. So let's say we drop it back down to $18. Okay, this business doesn't get out of the blocks. We see this a lot. People just not selling for a reasonable gross profit rate. Now, we've got this gross profit rate in here at 20%, takes into account the variable expenses. Now, you should think about that because you might have foreign exchange fees, which might be 1% in itself. But let's make that 0 for the moment, and we'll take this back to 20. So basically, this is after advertising. So if we want to look at what the gross profit includes, it's gross profit is your sales minus your cost of goods sold. And so in this, we've got products, freight, FBA, Amazon commission, advertising, variable expenses, and the gross profit percentage is the gross profit divided by your total sales. So we've got here at 28%. It's really just, as you can see here, right on the bottom level. You end up some more cash at the end of the year, but it's really quite tight. So that's at a 28% profit margin after advertising. Let's take it back and let's say there's no advertising. So it's 35%. So if we looked at that and we get, okay, well, that's our profit figure that we're looking at for making $255,000 that we did on the back of the envelope. So let's work this back. And so this is the profit with no advertising and no variable expenses. So we're looking at 35%, and you start dropping it down because you think, I can get more sales. It's really important that we get more sales. Then we can reach our goal. So we drop it down to $18, and we're just scraping along the bottom. We can't really afford to take out very much money here. So let's take it down to $17. Okay, we're really scraping along the bottom. We've got a minimum cash balance here for the first 3 years of 10 grand. We can see that gross profit rate there is sitting at 26%. So what we found is that if you start dropping your profit level, gross profit rate level, below 35% or 30%, you're going to start finding problems. So if we look at that 1650, well, let's go to 1650, and we go negative. Basically, this business fails. This is really, we've got $300,000 in sales, and you've got $3,700 in the bank. If you can't come up with extra finance to put into that, then you've got a problem. And when we look at the profit levels, it does boost up in this final year. You've got some cash available, but really that's about it. An important thing to remember here, if you've got to keep on putting money into your business, so if you've got your business and you're continuing saying, okay, I need to get Amazon lending to give me some more money, or I've got to go borrow to the bank, or I've got to go draw down on the business to get more stock, then there's something that you're doing wrong. And you will have to continue to put more money into the business. So if you put in your initial sum and then you're having to continue putting money into this business, there's something structurally wrong with your business. There's something wrong that means that it doesn't matter what happens, you're always going to have to put more money into this business. If this business is such that you're never taking any money out, what's the value of it? Now, what are you working for? And there's no reason to do that. So it's an important factor to think about where you're going to be with your business. So let's look at another example. In this quick example, we'll change the variable expenses to 1%. Let's put it back to 2%. And we've got selling at $20. But we're having trouble getting ranked, and we really need to spend 20% of our sales from PPC. And you can see here, we've got a problem. I mean, your gross profit rate's falling to 19%, and basically you haven't got any money. So if you're looking at saying, okay, I've got to generate a lot of money from PPC, or I need to generate the profits to generate the sales, I need to spend a lot on advertising. Let's say you're spending 25% on advertising, which is a fair proportion, then you need to make sure that you've got a decent gross profit margin there. So it's much higher than you think. If you're using advertising and the minimum price, matching the lowest performing person, the lowest price, then you've got problems with your business and it won't succeed because it will go negative. Bang, negative. You're out of business, basically what that means, because these figures will never occur. You'll sit at 365 or probably go down lower, and you'll never have the money to be able to introduce the new products. So your business basically stops. So, what to do now? Complete the form below and get your copy of our Amazon 4-year cash flow spreadsheet. Then, enter your numbers into the spreadsheet and see how your business will perform. Then, make changes to your numbers. See what difference that makes to your business. See the effect of lowering and rising prices. Change your growth projections. Change the advertising assumptions. Plus, stay tuned for more videos on our website where I will look into the different scenarios and case studies using this cash flow model.